both of you. May we move on then, please, to the highlight of the meeting, which is the financial report for month 8. Paul, over to you.
You are so kind as always, Malcolm. So the paper you have in front of you represents the state of my piggy bank, as the chair of the audit committee would doubtless refer to it, at the end of November. Thank you, David. On the face of it, it shows a significant improvement from the slight overspend that we talked about in December on the back of month 7. But you'll doubtless recall the conversation we had at that time, which showed that we were anticipating in our analysis of additional risks and mitigations a substantial underspend on legacy continuing healthcare claim settlements. And indeed that has now moved from the additional mitigations into the core forecast, accounting for 129 million of the total improvement of 176 million that you see in the paper in front of you. We've moved from a 31 million overspend back in December to a forecast underspend now of 145 million. The other main movements in that are just a few small but welcome improvements in the performance of specialised commissioning and the other direct commissioning budgets. So at many levels there is very little new news in the month 8 numbers. But if you do turn to Appendix A, which I think you'll find most useful, I can just take you quickly through the main features of the forecast, which in its operational elements has remained pretty constant over the last few months. Overall, you can see there the CCG sector is showing a 51 million overspend, made up of 24 CCGs with adverse movements, totalling 105 million, partially compensated by 18 with small underspends, totalling 39 million, and then a 15 million underspend on quality premium. To put it another way, and rather more simply, 8 out of 10 CCGs are more or less exactly on plan, and the rest are on balance slightly off plan in the wrong direction. It is noticeable that the North and London show overspends broadly equal to the underspends, whereas in the Midlands and East, and particularly the South, there is, so far at least, little underspend to offset those facing additional pressure. And in that context, it's hard to escape the conclusion that there is some link to allocations and distance from target in this pattern, which makes it all the more important that we accelerated the pace of change in allocation decisions in December to correct these historical misalignments of resource. It's also fair to say that the scale of individual overspends in the CCG sector has been smaller this year than in previous years, which is at least in part down to the extensive work that we've done this year with CCG colleagues to improve their financial resilience by detecting issues earlier and then initiating rapid turnaround actions where these have proved necessary. Turning to specialised commissioning, the operational performance of the regional teams has been much stronger this year, with overall spend held to within 0.2% of budget, which represents a real transformation in grip compared to recent years, which has seen much bigger overspends. The challenge we have, as we've debated on a number of occasions, is containing the Cancer Drugs Fund, which accounts for 70 million of the overspend you see here, with a fairly high probability that that figure will grow somewhat before the end of the year. That makes the steps we're taking to get better value from our investment in the CDF through the consultation due to be completed shortly all the more important. The other clear risk we have, as we discussed in the context of allocations last month, is the rapid rise of new drugs, and this year hepatitis C in particular, which still carries quite an element of uncertainty for 15-16 and will be a major financial challenge for us in 16-17 and beyond. You'll see that we've got some small underspends in the other areas of direct commissioning, particularly focused in the South and the North. And then on central budgets, the programme cost line reflects 3 main factors, all specific to 15-16. Firstly, following the successful completion of the transfer of primary care support services to Capita and of the cost reduction programme we undertook across NHS England's core operating structures at the beginning of the year, we've been able to release the reserves we took at the beginning of the year to cover transition and redundancy risks. And secondly, a couple of the budgets we administer on behalf of the Department of Health, covering clinical excellence awards and legacy IT programmes, have underspent by a total of 33 million. And then finally, and perhaps most significantly, in response to the request from the Department of Health to capture any underspends to support the overall balance required in the health sector, in the light of the significant cost issues in the provider sector, We've released the contingencies we took at the start of the year for unforeseen programme pressures, and also banked slippage where it's occurred in individual programme areas, notably in patients and information, commissioning strategy, and of course not to be left out, finance. I mentioned at the start of this overview that we've released 129 million of underspend on legacy continuing healthcare claims into the forecast this month, and you can see that split for technical reasons between other central costs and the snappily titled AME and technical line. And then finally, the 89 million towards the bottom of the table reflects the requirement under Treasury accounting rules to report depreciation underspends, including in the operating results above, against a separate budget. And of course, it's largely offset by the reserve we took for that purpose at the beginning of the year. So all in all, an underspend of 145 million, which, as I set out in paragraph 3.7 of the main report, grows to 207 million when additional net mitigations, notably further upsides on continuing healthcare claims, central programmes and potential rates rebate income, are taken into account. As I mentioned, this represents the position as we assessed it late in December. We've been taking a first peek at month 9 this week, with a particular eye on opportunities to contribute further to the overall balancing of the sector. It does look as if, despite the further growth in the overspend on the Cancer Drugs Fund, which I mentioned earlier, we will be able to increase our forecast after risks and mitigations from the current 207 million to somewhere a bit closer to 400 million, in part reflecting a positive response from CCGs and direct commissioning teams, and in part a few other once-off factors which we'll debate next time we meet. So overall, I think a strong financial performance from the commissioning sector in 15-16, with plenty of signs of improved control within the CCG and direct commissioning sectors. But we do also need to bear in mind that the 400 million or so of underspend, gosh, that was a terrible slip, the 400 million or so of underspend, the Chief Executive can relax, we are likely to be reporting at the end of the year, can be largely explained by two factors which simply won't be available to us next year. Namely, the legacy continuing healthcare underspend, because we've brought the budget for that down to a more aligned level next year in the allocations, and secondly, for similar reasons, the central cost reductions, which are either one-off in 15-16 or already reflected in the reduced allocations we agreed for 16-17, and you'll recall we deliberately took those down in 16-17 to maximise the money available for frontline services and for the transformation programmes that we'll be pursuing. So as we start to turn our attention to 16-17, as even the accountants must towards this time of the year, we'll have to find other ways of handling the undoubted risks in a year when operating budgets are going to be very tight. This should be helped by better alignment between allocations and need following our decisions in December, but it's also going to need real pace in planning and delivering the maximum possible impact from our programme of commissioner efficiencies. And the same is of course true of providers. The provider sector as a whole, led by NHS Improvement, has committed to ensuring that their deficit this year will not exceed 1.8 billion, and that can just about be offset by our underspend and the measures which the DH is putting in place to generate an underspend on central budgets and capital. But the provider sector is going to have to pull out all the stops to achieve that particular outcome for the year, and then perhaps equally important to sustain it recurrently as they go into next year. Because it's clear that we've only got 1.8 billion, as we discussed back in December, in the form of the fund, the Sustainability and Transformation Fund, the element of it that is due to offset the deficits coming into the year. So it's really important that that is sustained, as I've just described. You'll probably be aware NHS Improvement sent out letters to each provider with their core allocation from that fund and their expected control total for 16-17, and they've been holding meetings with all providers this week to outline the response required. So providers too will be working hard to identify the best way to accelerate their own efficiency programmes through their operating plans, and equally importantly, their longer-term sustainability and transformation plans. And of course, the real art here is not commissioners and providers going off into their separate corners and planning their respective efficiencies in isolation from each other, or perhaps sometimes one suspects in competition with each other, but rather the collaborative process of integrated health economy planning that we've set out in the planning guidance, which is frankly the only way that we're going to be able to convert survival in 15-16, which is, I think, the best way to describe, looking back at 15-16, what I hope we will have achieved by the end of the year, converting that survival into a sustainable proposition for the NHS for 16-17 and beyond, on which optimistic note I will stop.
Thank you, Paul. Let me invite any questions and comments to Paul.
I like the bit about collaboration. The question I was going to ask is whether we have a hypothesis for a testable hypothesis around variation. I mean, it relates to some of the points that Richard made. I just wondered whether we do have a testable hypothesis around variation in performance.
We certainly do. I mean, we certainly do. If I can just restrict it for a minute to the financial performance, clearly there's a whole lot of variation alongside it, which goes with it. As you probably know, the big mainstay of our efficiency programme next year is precisely a laser-like insight into variation delivered through the Right Care programme. So we're going to expose every bit of variation, both in spend and in outcome, actually, which brings together the two lenses, doesn't it? The economy lens and the health impact lens. And it seems to me that will generate not just efficiency opportunities, but the opportunity to drive up outcomes at the same time. That's, I think, the best means that we've got of doing it. To date, it's been a bit of a cottage industry. We've done it in about 20 health economies around the country with some transformational results. I know, Bruce, you've been involved in looking at some of those, and I think there is as much excitement on the clinical leadership front as there is on the financial and operational leadership front. That's the big thing, and the trick for us, I think, next year is how do you industrialise something which has been a real asset for 20 or so health economies who have been the enthusiastic evangelists for it to date. How do you industrialise that to cover 209 CCGs, as we intend to do? We're gearing up to do that, but we need to have real speed and pace with that. That's not tautology. Simply to keep ahead of a curve which isn't going to forgive us if we fall behind it in 16, 17 and beyond.
Because that's why I asked the question about our hypothesis, because ultimately it's about leadership, isn't it? It's about the decisions, the sort of strategic choices and decisions that people make. And I just wondered, given that we've got all this information, both financial, operational and OD, for want of a better term, whether we do have a hypothesis as to what the variation causes are, and therefore we can help the system change.
Yeah, well, I think we do, and I'd link it back to your very first observation, which is the key thing that has liberated the benefits where they've done Right Care to date has been the collaboration across both the functions concerned, so clinical and financial and operational people coming together, but probably equally important, if not more important, the collaboration between commissioners and providers. This isn't something that commissioners do to providers, or something that providers use to manage their own interests, as it were. This is something which inherently brings together the various parties in a health economy to a productive end.
Right, well, thank you. Thank you, Paul. I think you've done what every finance director should do by month 8, which is to reassure the board that we're heading in the right direction towards year end, to let us know how difficult it's been. But actually, I think full marks to you and for Simon for the internal management of the organisation that's getting us in that right direction, and also keeping us aware of the overall responsibilities of the whole of the health system in order to come in within the departmental expenditure limit. So thank you for that. May we then move on to item 8 on the agenda, which is the reports from boards committees. I get the impression from my colleagues that the reports may not need extensive introduction, but let me just check live. David, Commissioning Committee?
No, I think it's self-explanatory. Happy to take any questions.
Any questions for David? I take that as no. Investment Committee, Moira? Straightforward, thank you. Noel, Specialised Commissioning?
Nothing really to add, Malcolm, to what you see in the summary.
Thank you. By the way, this is a tribute to how good the reports are, not to the lack of interest on the part of the board. David, there's something with yours that I know you wish us to approve.
Yes, so the report, I hope, is self-explanatory. However, I do need to seek the board's approval. The committee considered the case for implementing a pilot of the government procurement cards. The committee was satisfied that this was a good thing to do, slightly surprised that it hadn't been done before, and therefore, but also slightly surprised that we needed formal board approval to use procurement cards, and therefore I seek the board's approval.
Are we content to approve that? We are, I think so. I'm also being reminded by Leslie that we need to approve specifically the revised terms of reference for the Commission.
Yes, we
Committee.
do.
So
Yes, we do.
if I may ask the board to do that as well. Thank you very much. Right, that brings us to any other business. I have no other business apart from the date of the next meeting. Does anybody have any other business?
Sorry, Chairman, just
Margaret.
before we leave the procurement cards, it occurs to me that because this is a pilot, that when the pilots work through, the board might then be asked to endorse moving from the pilot to the main, which seemed to me to be, perhaps the board's time could be used more constructively, and perhaps the board might want to delegate that to perhaps the finance director.
I would be entirely content with that. We'll just need to check the standing instructions and so on, but assuming that's the case, I think that's a very good suggestion. Mark.
Assuming we're permitted to do it, we do it.
I will try and live up to that onerous responsibility when it arises.
Right, well, there's no other business as far as I can see. I ask the board formally to pass the normal resolution of going into private session, and on that note, I close the meeting. Thank you very much.
Thank you, Mark.